Gold prices are clawing back slightly after a sharp 3% drop on Monday, triggered by optimism over a new US-China trade agreement. The rollback of tariffs has boosted risk appetite, drawing investors away from traditional safe havens like gold. But is this a brief dip or a sign of deeper weakness ahead? Well, joining us now is Nikos Tzabouras, Senior Market Analyst at Trading.com, to break down what the trade deal means for gold and whether uncertainty could still drive demand. Well, Nikos, thanks very much indeed for your time.
Hello, Devan. Thank you and your audience for having me. Clearly, risk appetite has returned and markets are turning their backs to safe havens like gold, as you already alluded to. The US-China tariff reduction is a clear de-escalation, and it follows a trade deal with the UK, and the White House points to more such agreements to come. That this trade optimism clearly represents a risk, along with the US dollar recovery, a risk for deeper pullback in gold prices.
Because that was my next question, and I'm sorry for coming in there, but I mean, given the temporary nature of the tariff reductions, I mean, do you foresee a resurgence in gold demand if trade tensions escalate again?
You're spot on, Devan. I definitely agree. Further negotiations are needed in these discussions for a comprehensive, long-lasting deal, not just with China, but with UK and others, which can actually be more complex. And tariffs are here to stay. We already have higher tariffs in any case. And this creates an environment where trade uncertainty is unlikely to go away, and an environment where gold's safe haven appeal can be rekindled and keep the door open to new record highs in terms of prices. And I would say it's not only trade, though. We also have geopolitical uncertainties and other factors that can support gold prices.
Now, holding on to a strategy or figuring out which strategy to use in this environment can be a tough one for investors. What sort of paths should they take under these circumstances?
Yes, definitely, Devan. Investors obviously need to exercise judgment and remain flexible in such volatile scenarios. But for those who are seeking to gain some risk-on exposure, if we want to stay within the commodities complex, I believe copper is something to look at. Copper benefits in case that we don't have an economic slowdown or not as bad as feared. And of course, it's indispensable to the artificial intelligence boom. And we see that big tech companies like meta platforms like Google have reaffirmed the commitment for higher spending in AI. So that could continue to drive consumption of copper.
Yeah, but so much of that really depends on what the sort of global GDP or the global growth is looking like, right? Because copper is used in so much infrastructure. So if we see, the world economy staggering a bit, there again, that's another negative for copper, isn't it?
Definitely, that exactly illustrates this volatile nature and this uncertainty that we have, and that's why investors need to exercise caution. And of course, if someone prefers to sort of stay within the risk of strong gold theme, there are still other alternatives if we don't want to stay within gold. But if we're staying again in the commodities complex, obviously we have silver, which also have safe haven attributes, but is also part of the renewable energies and part of the AI revolution. Or there are, of course, again, other safe havens, or maybe even mining companies, which we've seen that are doing really well, like a Newmont or others, or Barrick during this gold surge.
We were watching central bankers so keenly over the last few months, right, with all their gold purchases. I'm just wondering, how do you see central buying purchasing of gold coming up in the next few months? And how is that influencing the current price trends at the moment?
Instrumental, in one word. Central bank buying has been instrumental so far in the gold rally, and it's going to continue to provide a tailwind for gold, especially China, which sort of leads this de-dollarization effort, and which both increased its reserves for a sixth straight month in April, despite record high prices in that month.
If someone wanted to throw a question to you, and this puts you in a spot a bit, but do you see gold hitting a peak now or not?
It's really hard to tell. I believe this pullback has room for deeper declines. I would say that the 3,200 region, 350 region, with the 50 days exponential moving average. Sorry to throw a technical indicator there, but sort of to provide a level is pivotal, because a break below that could create room for even deeper decline. But if this region holds, it would reaffirm the bullish bias and keep the road open to new record highs. And I believe that despite this pressure now, gold still has tailwinds that will keep the record highs in play.
And just final question as I let you go, Nikos. What is the single most important factor you would be watching out for to determine what that movement will look like over the next few weeks for gold?
Trade developments. I know it's not the best answer, because we cannot plan around it or say this will happen and then that will be the gold reaction. But that's the state of play now. It's trade.
Well, we'll leave it there. Nikos Tzabouras, thanks very much indeed for joining us. He's the Senior Market Analyst at Tradu.com. Thanks very much.
Thank you very much.